Ladies and gentlemen, Archivist here. If you have been following the financial news, you have heard the cheering. You have heard the gold bugs celebrating Basel III. They are popping champagne corks. They are telling you it is finally over. The manipulation is ending. Gold has been reclassified as a Tier 1 asset. It is now officially risk-free money in the eyes of the global banking system. And they are right. Gold was saved. The lobbyists in London, the bullion banks in Switzerland, and the central planners at the BIS fought a secret war for 10 years to ensure that gold was given a lifeboat. They secured an exemption that allows banks to hold physical gold with almost zero capital penalty. But they are hiding the other half of the document. They are hiding the casualties of this new agreement. If you turn to page 40 of the Basel III framework, if you look at the section titled Required Stable Funding for High Volatility Commodities, you will see a list of victims: silver, copper, and platinum. While gold was promoted to the penthouse, the industrial metals were thrown into the dungeon. Under the new banking laws that are now fully enforceable as of 2026, any bank dealing in silver or copper faces a massive, mathematically destructive 85% capital penalty. This is the great split. This is why gold is hitting all-time highs, while silver and copper struggle to break out. It isn't about supply and demand anymore. It is about regulatory cleansing. Today we're going to open the file on the 85% rule. We are going to show you why the banks are furiously buying physical gold while simultaneously destroying the paper markets for silver and copper. And we are going to explain why this bureaucratic rule is about to cause a liquidity vacuum that will starve the global economy of the metals it needs to build the future. To understand why the silver and copper markets are breaking, you have to unlearn everything you know about trading. You have to stop thinking like a trader and start thinking like a bank risk officer. For the last 40 years, the global commodity market ran on paper. It ran on unallocated contracts. Here's how it worked. A bank like JP Morgan or BNP Paribas would lend money to a copper miner in Chile, or they would lease silver to a refiner in Switzerland, but they didn't use their own money to do it. They used short-term funding. They borrowed cheap cash from the overnight markets, lent it out at a higher rate, and pocketed the difference. It was the carry trade. It was easy. It was profitable. And most importantly, it required very little of the bank's own capital. But after the 2008 crash, the regulators in Basel, Switzerland, decided that this game was too risky. They introduced the Net Stable Funding Ratio, NSFR. This is a boring acronym that rules the world. The NSFR asks a simple question. If you have a risky asset on your books, like a silver lease or a copper loan, how much of your own money do you have to lock up to cover it? In the old days, the answer was 5% or 10%. Under Basel III for industrial commodities, the answer is 85%. Let me explain the violence of that number. Imagine you want to buy a house to rent out. In the old world, the bank said, put down 10% and we will lend you the rest. You make a massive return on investment because you're using leverage. In the Basel III world, the bank says, you must put down 85% cash. Suddenly, the deal makes no sense. Your return on equity, ROE, collapses. You can't make a profit. So what do? You don't buy the house. This is exactly what is happening to the silver and copper desks at the major banks. The risk officers have run the math. They have realized that holding a silver lease or financing a copper shipment now requires them to lock up 85% of the value in stable funding, expensive long-term equity. The cost of that capital is higher than the profit from the trade. So the banks are doing the only logical thing. They are closing the desks, they are exiting the sector. This is why liquidity is drying up. It is not a shortage of metal yet. It is a shortage of anyone willing to touch the metal without losing money. Now you might be asking, Archivist, if Basel III hates commodities, why is gold soaring? Why are the banks buying gold? This is where the story turns into a crime scene, because gold should have been on that list. Gold is volatile. Gold doesn't pay interest. By the strict definition of the NSFR, gold should have been hit with the same 85% penalty. But gold has the LBMA. The London Bullion Market Association spent years lobbying the Bank for International Settlements, BIS. Their argument was simple. Gold is not a commodity. Gold is money. It is a high-quality liquid asset, HQLA. They argued that because gold is held by central banks, and because it has deep liquidity during a crisis, it deserves an exemption. And they won. The regulators caved, allocated physical gold was reclassified, it was moved up the ladder. In many jurisdictions, including the UK and EU, the required stable funding factor for gold was reduced dramatically, effectively treating it as a Tier 1 asset. Do you see the difference? Gold. The bank holds it and the regulator says, good job, this is safe capital, no penalty. Silver copper. The bank holds it and the regulator says, this is toxic waste. Lock up 85% of your capital or sell it immediately. This created a bifurcated market. The banks are de-risking their balance sheets and they are selling the penalty metals, silver and copper, to get them off the books, and they are taking that cash and buying the safety metal, gold, to meet their capital requirements. This is why you see the gold to silver ratio widening. It isn't market sentiment, it is regulatory arbitrage. The banks are being forced by law to love gold and hate silver, but the story gets worse for the paper trader. The 85% rule doesn't just apply to physical inventories of industrial metal. It applies even more aggressively to unallocated paper. For decades, the silver market was suppressed by paper silver, claims on metal that didn't exist. Banks would sell unallocated accounts to retail investors, charging them storage fees for metal that wasn't there. It was free money. Basel III kills this scam. Under the new rules, an unallocated liability, owing silver to a customer without matching physical metal, is a funding risk. The 85% penalty applies. So the banks are now looking at their millions of paper silver clients and saying, we can't afford you. This is why we are seeing banks raising storage fees. This is why we are seeing them force cash settlements. They are trying to purge the paper clients because the regulatory cost of maintaining the illusion has become too high. They are unwinding the paper shorts, not because they want to let the price rise, but because they can no longer afford to suppress it. The manipulation machine runs on leverage. Basel III just took the leverage away. And we cannot ignore copper. Copper is the most critical metal for the global economy. It is the blood in the veins of the electrical grid. It moves in massive volumes, millions of tons per year. Financing these shipments requires billions of dollars in credit lines. But copper is hit by the same 85% rule. The banks that used to finance the ships from Peru to China, the banks that used to finance the warehouses in Rotterdam, they are stepping back. Societe Generale, BNP Paribas, the commodity giants are shrinking their books. This brings us to the terrifying conclusion of Part 1. We have established that the banks are leaving the room. They are taking their ball and going home because the rules of the game have changed. But the world still needs the metal. Tesla still needs the copper. Samsung still needs the silver. The physical demand is at an all-time high. But the financial bridge, the banking system that moves metal from the mine to the factory, is being blown up. So what happens when you have a physical shortage combined with a financing freeze? What happens when the mines have the metal but the traders can't get the loan to put it on a ship? You get a supply chain heart attack. You get a situation where the metal exists, but it cannot move. And when metal cannot move, the price at the destination, the factory, goes vertical. In Section 1, we established the crime. The Basel III regulations have imposed an 85% capital penalty on banks that finance silver and copper. But most people don't care about bank capital ratios. They care about price. So how does a boring banking rule in Switzerland cause the price of copper wire or a silver coin to explode? The answer lies in a document you have probably never seen, but which controls 90% of global trade. It is called a letter of credit, LC. When a miner in Chile wants to ship 50,000 tons of copper concentrate to a smelter in China, they don't just put it on a boat and hope to get paid. They require a bank to guarantee the deal. The Chinese buyer goes to their bank, let's say HSBC, and asks for a letter of credit. The bank promises to pay the Chilean miner once the ship arrives. Without this piece of paper, the ship does not leave the port. The captain will not lift the anchor. In 2024, getting an LC for a copper shipment cost about 0.5%. It was a rubber stamp, but today, because of the 85% rule, the bank looks at that copper LC and says, to issue this $50 million guarantee, I have to lock up $42 million of my own equity. That is financial suicide. So what happens? The letter of credit is denied, or the bank charges a 10% fee to issue it, destroying the profit margin of the miner. This is the financing freeze. We are seeing reports from port authorities in Antofagasta, Chile, and Callao, Peru, that concentrate stockpiles are reaching critical levels. The metal is physically sitting there. The miners did their job, but the paperwork to move it has been criminalized by Basel III. This creates a phenomenon that is confusing the algorithms. The satellite photos show piles of copper and silver concentrate at the ports. The Goldman Sachs analysts look at the photos and say, look, there's plenty of supply. Inventory is rising. Price should go down. They are wrong. They are looking at ghost inventory. Metal that sits at a port with no financing is effectively zero. It cannot reach the factory. It is like seeing a loaf of bread behind a bulletproof glass window. It exists, but you will starve to death looking at it. This is causing a supply chain heart attack. The blood metal is stuck in the heart, the mine, and cannot reach the limbs, the factories in Asia and Europe. And when the limbs don't get blood, they start to panic. We are already seeing the desperation in the spot premium market. While the COMEX paper price for copper is trading at $4.20, the Shanghai premium for immediate delivery has spiked to historic highs. Factories are bypassing the banks entirely. They are trying to pay cash. They are trying to barter. They are realizing that the banking system is no longer a bridge. It is a blockade. Now let's look at how this specifically targets silver. Silver is in a unique hell. It is half money, half commodity. But Basel III treats it purely as high volatility toxic waste. The 85% rule has destroyed the leasing market. For decades, refiners would lease silver from bullion banks to run their operations. They wouldn't buy it. They would rent it for 2% a year. Basel III says a lease is a loan. The 85% penalty applies. So the banks have recalled the leases. They called the refiners and said, return the metal or buy it outright at full price. This has drained the liquidity out of the wholesale market. The float, the available metal that greased the gears of the industry, is gone. This explains the volatility we are seeing. When liquidity disappears, price movements become violent. A small buy order moves the price up $2. A small sell order crashes it $2. The shock absorbers, the leasing market, have been removed by the regulators. We are driving a car with no suspension down a rocky road, and here is the final proof that the banks know what is coming. Look at who is selling the paper and who is buying the physical. The banks are aggressively closing their unallocated silver accounts. They are sending letters to clients. We are discontinuing our precious metals custody services. Please liquidate your position or find another custodian. Why? Because unallocated silver is a liability that attracts the 85% penalty. But watch what they are doing with gold. While they kick silver clients out the front door, they are backing trucks up to the back door to load allocated gold bars. They are using the Tier 1 exemption to hoard the only asset that counts as high-quality liquid assets, HQLA, on their balance sheet. They are de-risking into gold. They are preparing for a system where industrial commodities, silver, copper, become scarce and impossible to finance, while gold becomes the only liquid collateral left in the banking system. It is a bifurcation of wealth. Gold for the bankers, shortages for the people. So we have a frozen supply chain. We have banks exiting the trade. We have ghost inventory rotting at the ports. But there is one final domino that has not fallen yet. It is the price explosion. You might be thinking, Archivist, if supply is stuck, why isn't the price at $100 yet? Because the market is currently in the deflationary phase of the credit crunch. The lack of loans makes it look like demand is falling. But the moment the factories run out of their current stockpile, the deflation turns into hyperscarcity. In the next section, I'm going to show you the factory zero signal. I'm going to show you the inventory levels of major electronics manufacturers in Asia. And I'm going to explain why the price lag is your final window of opportunity before the real price destroys the paper price forever. We have arrived at the most dangerous part of the investigation. This is where the amateur traders lose their money and the institutional predators make their fortunes. Because right now you are looking at your screen and you're confused. You're asking, Archivist, you just told me the ships aren't moving. You told me the copper is stuck in Chile and the silver is blocked by the 85% rule. So why is the price dropping? Why isn't silver at $100 today? The answer lies in the mechanics of a credit crunch. Basel III didn't just stop the ships, it stopped the money. When the banks pulled the credit lines, the letters of credit we discussed in Section 2, the first reaction wasn't a price spike. It was a liquidation event. Think about the traders who were holding copper and silver on margin. Suddenly their financing costs jumped 85%. They couldn't afford to hold the position. So what did they do? They sold. They dumped their paper contracts into the market to raise cash and pay off the banks. This is what we are seeing right now. The paper price is crashing because the speculators are being forced out of the casino. But while the price is dropping, the physical inventory is not being replaced. This is the deflationary trap. It is the calm before the tsunami. The paper market is telling you supply is plentiful because everyone is selling contracts, but the physical reality is that the pipeline is empty, and we are about to hit the moment where the rubber meets the road. We are about to hit factory zero. To understand factory zero, you have to look at how modern manufacturing works. Toyota, Samsung, Tesla, none of them keep 6 months of copper wire or silver paste in a warehouse. That is expensive. They use just-in-time, JIT, manufacturing. They rely on a steady stream of ships arriving every Tuesday to keep the line running. They keep maybe 2 weeks of inventory on hand. But remember the shipping freeze? Remember the letters of credit that were denied 3 weeks ago? That gap in the supply chain is currently moving across the ocean. It hasn't hit the factory floor yet. The factories are still running on the inventory they bought last month. But in about 14 days, that inventory hits zero. The manager at the Samsung plant in Vietnam is going to go to the loading dock expecting a delivery of silver paste. And the truck won't be there because the ship never left Peru, because the bank didn't sign the Basel III paperwork. This is the moment the paper price dies. When a factory stops, it costs billions of dollars. Do you think Samsung cares if the COMEX price is $28 or $24? No. They care that they have no metal. They will panic. They will pick up the phone. They will call the refiner directly. They will say, I don't care what the screen says. I will pay you $50 an ounce. Just get me the metal. We're already seeing the early signs of this. It is called the ghost market. This is a private market that operates completely outside of the London Metal Exchange, LME, and the COMEX. I've spoken to sources in the logistics industry in Singapore. They are reporting a massive increase in direct offtake agreements. Major industrial users are bypassing the banks. They are going directly to the miners and refiners and signing long-term contracts at prices 20% to 30% higher than the spot price. They are locking in supply now because they know the banking channel is broken. This is the ultimate proof of the bifurcation. The public price, COMEX, LBMA, LME, is dropping due to the Basel III credit crunch and paper liquidation. The private price, the ghost market, is exploding due to physical scarcity and the fear of factory zero. If you are buying based on the chart, you are trading the liquidation of a bankrupt system. If you are buying based on the ghost market, you are front-running the inevitable panic of the industrial giants. And it isn't just companies, it is nations. China knows about Basel III. India knows about Basel III. They know that the Western banking system is making it impossible to finance commodities. So what are they doing? They are hoarding. Look at the import data for the Shanghai bonded zone. Copper inventories in London are falling. Copper inventories in Shanghai are rising. Why? Because the Chinese state banks, which play by different rules, are financing the cargoes that Western banks are rejecting. The 85% rule is effectively a sanction on Western industry. It is forcing the metal to flow to the east, where financing is still available. So when Factory Zero hits the west, when General Motors and Ford realize they can't get copper wire, they will look for supply, and they will find that it is all sitting in a warehouse in Shanghai, owned by a strategic adversary who is in no hurry to sell. So the trap is set. The Basel betrayal has bifurcated the world. Gold has been saved as a banking asset. Silver and copper have been abandoned as toxic waste, and the supply chain heart attack is weeks away from hitting the factory floor. So what do? How do you position yourself when the paper price is crashing, but the real price is about to go vertical? You have to stop acting like a trader and start acting like a central bank. In the final section of this dossier, I'm going to give you the Archivist Basel protocol. I'm going to tell you exactly how to trade this dip, why you must avoid the ETFs, and the one specific signal that will tell you when the Factory Zero panic has officially begun. We have walked through the regulatory crime scene. We have seen the Basel betrayal, the 85% penalty. We have seen the financing freeze, the letter of credit denial. We have seen the Factory Zero logic, the impending supply cliff. But knowing the crime isn't enough. You need to know how to survive the fallout. Right now, you're staring at a chart that looks broken. You are seeing the price of silver and copper drift lower while gold hits new highs. Your instinct is to follow the trend. Your instinct is to sell the losers and buy the winner. Do not do that. You're witnessing a liquidation event, not a valuation event. The price isn't dropping because the metal is worthless. It is dropping because the banks are forbidden from holding it. This creates the greatest asymmetric opportunity of the decade. Here is the Archivist's Basel protocol. These are the 3 rules you must follow to survive the Great Split. Rule number 1, you must be your own central bank. The 85% rule makes paper silver and paper copper toxic. If you hold an unallocated account, a pool account, or a futures contract, you are effectively renting space on a bank's balance sheet. But the bank wants you gone. They will raise fees, they will widen spreads, and eventually, they will force a cash settlement at the worst possible moment. You must move to allocated segregated storage or personal possession. When you hold physical metal in your own name, you bypass the Basel penalty entirely. The 85% rule applies to bank financing, not private ownership. By taking delivery, you're removing the asset from the regulated system and placing it in the free market. You are effectively smuggling value out of the burning building before the doors lock. Rule number 2, avoid the authorized participant risk. Many of you hold SLV, silver, or COPX, copper miners, in your brokerage account. You think you are safe, but look at the structure of an ETF. Who creates the shares? Who manages the physical inventory? The authorized participants, APs. And who are the APs? JP Morgan, Citi, HSBC, the exact same banks that are being strangled by the 85% rule. If these banks decide to exit the commodity business because it is no longer profitable under Basel, who provides the liquidity for your ETF? Who steps in to arbitrate the price? No one. In a factory zero scenario, the ETFs will decouple. They will track the liquidation price of the banks, not the scarcity price of the street. Do not rely on a vehicle driven by the very people who are abandoning the car. If you want exposure to copper, buy the physical metal if you have the space, or buy the royalty companies that get paid off the top line, bypassing the banking financing risk. Rule number 3, watch for the flip. How will you know when the credit crunch dip is over and the hyper-scarcity spike has begun? You watch for one specific signal, backwardation. In a normal market, the future price is higher than the spot price, contango. But when industry is starving, when Samsung needs silver now, the spot price flips above the future price. We are already seeing this in the London copper market. The cash to 3-month spread is tightening. This is the scream of a dying supply chain. When you see the spot price of silver trade $0.50 higher than the futures price, that is the starting gun. That is the moment the paper shorts have lost control. That is the moment Factory Zero has arrived. Do not wait for CNN to announce it. By the time they do, the premium will be $10. So, let's summarize the new reality. We are living in a bifurcated world. On one side, we have gold, the Tier 1 king, protected by the BIS, hoarded by central banks, the ultimate inside money for the elite. Gold will do well. It is the safe haven. On the other side, we have the commodities, silver and copper, the penalty class, abandoned by the banks, impossible to finance, but absolutely essential for human civilization. The banks have tried to kill the price by killing the funding, but they have only succeeded in killing the supply. We are about to see what happens when an immovable object, Basel III regulations, meets an unstoppable force, industrial demand. The banks can print money, they can print laws, but they cannot print copper. They cannot print silver. The great split is here. Gold is for the bankers. Silver and copper are for the people who understand that scarcity is the only law that truly matters. This is Archivist. The protocol is active. Class dismissed.